All right, and it's time now for data point on two key issues. That is the NHIF contributions as well as what the Central Bank of Kenya announced sometime this week. And of course, the proposed NHIF rates are at 2.75% of the gross pay. This is something that had been put to public participation. We're waiting to see the next course of action. But some of the proposals include that the minimum should be 300 shillings contribution. Of course, a decline from the current 500 shillings. Those unemployed, however, and they are not requiring assistance of the government, they'll be required to contribute up to 1,000 shillings per month. Currently, the maximum contribution is 1,700, but that proposal to raise it to 2.75% is going to have an impact, especially for the salaried workers. For instance, this is the current payslip of 50,000 shillings, a person earning 50,000 shillings. Last week, we looked at the impact of the housing levy to their payslip. But now, if the NHIF contribution, this one here, currently they are paying 1,200 shillings. If it is to be implemented at 2.75%, they'll be required to contribute 1,375 shillings, and therefore, if you are to include that deduction to the housing levy, which is to be 1.5%, which is 750 shillings, then the total deductions will rise from 9,159 to 10,058 shillings, and the take-home before all other deductions, if you have a contribution towards a SACCO, if you're paying a loan, then that would be at 39,942, quite a decline of close to 1,000 shillings from the current payslip. And then if you have someone who earns 200,000 shillings gross pay at the moment, currently this is the match they take home, 145,416 shillings. But should the NHIF rates become effective at 2.75%, their contribution will rise from 1,700 shillings to 5,500 shillings. Look at that, a difference of just over 3,000 shillings. But also, something to note is that the NHIF relief, currently at 255 shillings, if you had to contribute 5,500, then the NHIF relief will rise to 825 shillings, bearing in mind it is 15% of the premium, but capped at 5,000 in terms of how much you can get a relief from. Therefore, that will take home about 139,000. The total deductions will be 60,800, and therefore the pay for this person in July, were the NHIF rate to become effective in the new month, then their salary take home will reduce by 6,221. Then, if you earn 1,000,000 shillings, this is where it bites most, because at the moment they take home 705,416. But should the NHIF rate be applied, 2.75% of 1,000,000 shillings would be 27,500 shillings for such a person. Consider that they have a housing levy which is already low and will be effective at the end of the month of July, 15,000. So all that, but they'll get an NHIF relief which is better than anyone else. Currently 255 shillings because the contribution is 1,700, but the relief with this contribution would be 4,125. The asterisks there indicate that this assumes that they have no other reliefs that they need, insurance reliefs that would require them to be denied that, bearing in mind that the maximum relief you can get from insurance contributions would be 5,000 shillings. So the take home from 1,000,000 shillings would be 650,986, or 65% of their gross pay. And that means that the reduction, their salary will reduce by a whopping 54,430, were this to be effective starting the end of July. Now, let's take a look at something else that has been happening. On the 26th of June, the Central Bank Governor, that is Kamau Thuge, announced that the meeting of Monetary Policy Committee decided to revise the central bank rate from 9.5% to 10.5%. Of course, this is the match that the minimum at which Central Bank of Kenya can lend to commercial banks. What does that mean for the money market? One of the things that you need to know is that there's a rate that they call interbank rate. This is where banks can lend to each other. It can be overnight or up to 1 week. It's short-term basis. And this is meant to manage liquidity within a bank, and therefore also to satisfy regulations that require certain proportion of cash reserves on regularly. But now this obviously depends on money in the market in terms of how much a bank can lend to the other. But the Central Bank of Kenya will give what the interbank rate is at the moment. As of 27th of June, which is the day before yesterday, it was at 10.045%. And obviously this rate is on the rise. Remember, the central bank rate at the moment is 10.5%. Then something else to consider is about why raise the central bank rate to 10.5. It was at 9.5. Part of the reason, they're looking at the economy and deciding and finding that there's a bit of more money in the market that needs to be brought back into to banks. And therefore, to encourage savings in banks and to have attractive returns, that's why they're introducing a higher rate. And of course, to attract Kenyans to government security because the returns, again, are attractive. Now, what you would expect with that is that there would be more savings, which means there is less spending in the country. And therefore, you would expect in a normal economy that that would lower the inflation rate. Talking of inflation, at the moment, it is at 8.03% in the month of May. We're waiting for the figures for the month of June. As soon as it ends, the inflation has been on the rise compared to the previous month, which was below, in April, which was below 8%. And the causes of this inflation rise were attributed to electricity costs because the new tariffs became effective in the month of April. The sugar prices, you must have seen that they have spiked. And of course, the fuel prices went up a little bit in the month of April. But tomorrow, we're expecting that EPRA should announce the prices, and the estimation is about 10 shillings on top of the current palm prices. So obviously, this is expected to push up the inflation rate. So despite the efforts by the Monetary Policy Committee to raise the CBR to deal with the inflation, there's also something that is happening that might actually end up raising the inflation. So implications of the CBR rate is that the interbank rate may rise because banks may want to also take advantage of the increased returns. The bank lending interest rates may rise, especially because also the what you call the base lending rate has risen to about 13.2%. So more expensive loans are expected. More expensive mortgages are expected, especially if your rate that you got the loan at is fluctuating. If it is fixed, then you're safe. If it's fluctuating, then you might be affected by the changing rates. So obviously, we expect that there will be reduced demand for loans. And obviously, informal lending might grow. Out of Shylocks, that may be an avenue that people may want to explore. And therefore, for instance, just in ending, if you have a bank that has gotten the base lending rate at 13.2%, and a bank is giving a margin of, say, 8.5%. So you take 13.2% plus 8.5%, you'll end up at about 21.7% would be the effective rate for your loan. But obviously, this depends. That margin depends on the perceived customer risk profile, the cost of due diligence processes, and of course, the speed and cost of collateral perfection. And this means how much it takes you, especially if you're using land as the collateral for your loan. These are just some of the things that you need to consider. And these are changes coming from the Monetary Policy Committee that met on the 26th of this month, and they are expected to meet again in a month's time. Ordinarily, they should meet every 2 months, but probably because of what is happening in the economy, they may need to meet more regularly. And that is Data Point tonight.